Federal Home Loan Bank of Des Moines, and together with Brett Manning, who is on the line from Seattle, we work with our member financial institutions on developing balance sheet strategies. Today, I'd like to review several things: our multiple term advance structures, how term advances are used by members, advance refinance strategies, the concept of dynamic blended and laddered balance sheet funding strategies, and then finally, to demonstrate a blended funding case study that would involve the retention of mortgages. I'd like to discuss a few operational matters before we launch. This is the second webinar in a four-part series. Many of you listened last month to a webinar that we launched regarding marginal cost of funds. We'll give you more details on the additional two webinars that we have in store when we conclude the webinar. Next, all registrants will shortly be sent a link to the webinar presentation. We will also have, as you can see on the right-hand side of your screen, have a chat feature. On this sidebar, feel free to type in any questions you might have as we go along, and we'll address them either during or at the end of the webinar. Finally, we'll have several questions throughout the webinar, and we'll poll our viewing audience. Please cast your votes on the side panels when we prompt you to do so, as we'd like to measure your thoughts as we move along. So I'd like to spend a few minutes on reviewing term advance features and structures. We'll use this review really as a foundation for building balance sheet strategies that we'll discuss towards the end. Many of you know that there's a handy product guide on the FHLB Des Moines website that can give you a view on the product repertoire. You can access this guide off the rates page. I'll review a few of our term rate products at this point, and also I'll be confining the discussion during this webinar to strictly term advances without dealing with the structural features or optionality. We'll leave discussion of strategies involving such things as symmetrical prepayment structures, forward starting features, and convertible advance applications for subsequent webinars that we've scheduled for September 12 and October 10. And you can get details and registration details on the website. So we'll classify non-structured term advances for this purpose into four categories: overnight, repo, short-term, and long-term. These categories are primarily delineated by maturity, with repo advances ranging from 3 days to 6 months, and we'll call short-term advances ranging from 6 months to 1 year. A long-term advance can post a maturity from 1 year all the way out to 30 years. And again, note that there are no minimum amounts associated with the overnight Fed funds advance, and that the key difference between a repo advance and a short-term advance concerns the fact that the repo advance has principal and interest that's paid at maturity, while short-term advances call for interest to be paid on a monthly basis. So it's always good to generally think of non-structured term advances as the analogy of just-in-time inventory for manufacturing companies. Funds are available, as you know, from the FHLB Des Moines on immediate demand for liquidity and for the purpose of balance sheet management. Now, frequently members use adjustable rate funding, particularly LIBOR-based, for matching funding of variable rate loans. We'll talk more about these adjustable rate loans in a minute. Let's talk about overnight advances. Overnight advances, they're very easy to execute. They're available for funding until 5 p.m. Central Time and can be funded via e-advantage in amounts below $15 million. Above $15 million, feel free to pick up the phone. Unlike lines that may be offered by correspondence, there are no cleanup periods that are required. Further, we see many members that manage their cash balances to zero every day that are using the overnight Fed funds advance. Note that funds can be rolled into the next day with no daily payoff that's required. So, aside from seasonal liquidity purposes, we often see members deploy short-term advances to alter their interest rate risk profile. A typical case for reduction in liability duration could be a member that is excessively asset sensitive and would like to shorten liability durations as a replacement or a complement to extending asset durations. So with that, Brett Manning is going to administer a polling question, and again, feel free to vote using the panel on the right-hand side of the screen here, but we'd like your views on a couple of subjects. And we're going to open the poll. Now here's the first question. I'd like to just take a pulse of your institution. In terms of your institution's current net interest income, that's your current net interest income, does your ALM model depict your institution currently as being, and I'll give you 5 choices, heavily asset sensitive? Are you somewhat asset sensitive? Is your balance sheet net interest income neutral? Or are you somewhat liability sensitive? Or are you heavily liability sensitive? Let's take a pulse of the audience and see where the interest rate positions are. Feel free to vote here. The polls are open. We'll give you about 30 seconds. Okay, Brett, any feedback on the poll? We'll keep it open here for just about another 5 seconds. Okay.
Yeah, John, returns are looking good. It looks like about 77% of the attendees have voted. So why don't we close the poll and see what the results say?
All
Sharing
right.
the results. Looks like 13% of you are heavily asset sensitive. 41%, the clear winner, are somewhat asset sensitive, and that makes sense given where rates have been and balance sheets are positioned. 11% of you are neutral. 29% are somewhat liability sensitive. And last but not least, 5% of you denote yourselves as heavily liability sensitive. John, back to you.
That's great information, Brett. It's tilting somewhat on the asset sensitive side. To that end, I'd like to propose a follow-up question to the audience, and assuming that you have interest rate risk, and let's assume that all of us have interest rate risk, I'm going to give you 4 choices in terms of how you would mitigate or ease up on that interest rate risk. Here are the 4 choices. What would be your top choice? Choice number 1, alter the duration of your investment portfolio. Choice number 2, adjust your loan and deposit mix. Choice number 3, employ wholesale funding, such as advances, to adjust liability duration. Or choice number 4, employ derivatives to adjust balance sheet duration. So why don't we open the polls here? I'll repeat the choices. Pick one. You're going to mitigate interest rate risk by altering the duration of your investment portfolio, by adjusting your loan and deposit mix, by using wholesale funding, or by using derivatives. Which of the 4? Brett, we'll keep the polls open here about another 30 seconds.
Sounds good, John.
Let's give it another 5 seconds for the last-minute voters here, Brett.
All righty. It looks like we're up to an 85% voter participation, so that's pretty good. Let's go ahead and share the results.
Okay.
So the clear winner is to employ wholesale funding to adjust your liability duration. 47% of the respondents would choose to use wholesale funding. Coming in second place is adjust your loan and deposit mix. 29% of the responders chose that option. Coming in third, you would use your investment portfolio and your liquidity to alter your duration. And last but not least, only 2% of the respondents would actually use derivatives to adjust their balance sheet duration. Interesting results, John.
Very interesting results indeed. Number one pick by the listening audience is to mitigate interest rate risk by using wholesale funding, aka advances, to adjust duration. Perhaps this interest in this option is due to really the instantaneous nature of being able to tweak your interest rate risk by going to eAdvantage or simply picking up the phone. Very interesting result. So as I'll illustrate, long-term advances, let's talk about them for just a second. Although they're frequently associated with that classic lock it in before interest rate risk, before interest rates increase balance sheet type of strategy, long-term advances can really be used as key pillars for blending funding strategies, and they can also be applied for the purpose of funding mortgages, or for that matter, commercial loans of all types. And think about this. If you want a 5-year duration, you know what you're getting with a 5-year advance, a 5-year duration. Often it's useful to ask the question, can the same thing be said with a term CD's duration? Well, not really. If rates were to increase steadily and your penalties for early termination were, say, 6 months, you could get savvy consumers which easily could see the benefits of reinvesting at a higher rate. So long-term advances also represent the preponderance of advances associated with the Community Investment Advance Program, the CIA program. The CIA program is a great low-cost source of funds for loans in your community. For members of FHLB Des Moines, meeting the credit needs of their local community is being a good neighbor. It's good business. Housing and economic development projects are vital to the health of a community, and members can use these CIA advances to support these projects. Members are simply provided long-term fixed-rate advances at lower rates for eligible residential and commercial loans. The standard requirements of FHLB Des Moines credit and collateral policies apply to these special advances just as they do to all advances. So FHLB Des Moines members are provided a CIA advance limit of $10 million, and that was effective. It was raised January 1 of this year, and this limit is reduced by the outstanding balance of member community investment advances and are subject to program limits. So let's deal with two aspects of the the community investment advance. They're divided into the commercial and the residential world. I'll just give a few minutes for each. The commercial lending advance is designed to back qualifying development projects. Advances may have maturities ranging from 1 out to 30 years with a minimum borrowing level of $25,000. Eligible projects could include commercial loans in targeted areas, small business loans, or they could be projects that support targeted incomes, which are 115% of rural area median income and 100% of urban area median income. There is a maximum 90-day look-back period. Also, once you've reserved a CIA allocation, you're going to need to certify that a qualifying loan has been made within 12 months of the date of the CIA advance. It's an easy process. Talk to your relationship manager if you've got interest in this. Very, very easy to put together. Procedurally, all you need to do is submit a request form to the Community Investment Department with each advance request, and you're going to include such information as the name of the borrower, the project location, loan closing date, loan amount, number of projects or jobs you've created or retained. So let's talk about the residential version of the Community Investment Advance. It can be 1 to 30 years in maturity with a minimum borrowing of $100,000. Eligible projects can be pegged to targeted areas irrespective of borrower's income. You'd need to send to the Community Investment Department information that includes borrower's income, rent schedule, if applicable. And also the residential segment of the CIA advance need not necessarily be matched with a loan that you made or are planning to make. For instance, it's common, we see this a lot of times, that members match a CIA advance against a Fannie Mae DUS, or debt underwritten security bond that, for instance, could be financing a multifamily project in a targeted area. So as you can see from this graph of historical 5-year advances, there is a discount against posted advances that's typically on the order of 20 basis points or so. Many members view the CIA program as really the preferred first line for any term advance usage. So this graph, again, 20 basis points of variance with normal pricing, kind of piques our curiosity. So we'd like to poll the audience again, and just curious, how many of your institutions have used community investment advances? We'll take 3 answers as we open the poll here. We'll take a yes, or we'll take a no, or we'll take a not sure. Brett, let's open up the polls for 30 seconds. Have you used CIA advances? Have you used CIA advances? The answers would be yes, no, or not sure.
Let's give it about another 10 seconds, John.
Okay.
All righty. John, it looks like you have some homework to do, my friend. 44% of the responders have never used CIA advances, and 15% aren't entirely sure.
Okay, and remember what I just said. I said that many members who have used the CIA program see it as their first line for any term advance usage. Feel free to pick up the phone, talk to your relationship manager, and get hooked up into this program. Okay, long-term advances. They need not necessarily be structured as bullet advances, although typically they're quoted on a monthly amortization frequency basis. They can be structured with amortizing features that can be customized with multiple balloon and custom payment schedule features. They are offered either on a level payment or a level principal payment basis. As we know, level payments entail equal P&I payments over the life of an advance, while level principal payments feature equal principal payments over the life of the loan. Amortizing advances can be structured with delayed principal repayment features, and they're also available under the CIA program. In the adjustable rate term camp is, as I mentioned earlier, the LIBOR indexed advance. Rate resets are typically available at 1, 3, or 6-month frequencies, with terms ranging from 1 year all the way out to 10 years. We often see members use LIBOR indexed advances to match variable rate loans or LIBOR-based variable rate mortgages. In some cases, LIBOR-based advances are used as the variable rate funding leg against a fixed rate swap, which collectively could be used as a source of fixed rate funding. Advance pricing is quoted as a spread to LIBOR. So finally, I'll bring up the subject of prime rate advances. They're quoted at a spread to prime, logically a negative spread to prime, of something these days on the order of 228 basis points below prime. Prime rate advances are a great way to match fund such things as SBA loans and securities and manage the basis risk. Why not look at retained SBA loans as an example? Retained prime-based SBA loans have been priced recently, as an example, net of guarantee fees, in the vicinity of prime plus 195 for self-originated whole loans. With a prime rate right now of, I believe it's about 425, that loan would have an assumed yield of about 620. Offset that against a 7-year prime rate indexed advance with a spread to prime at negative 230. The advance could initially be priced at 195, implying an assumed spread of 425. A lot of numbers, but if you've got SBA loans that you are retaining and originating, call your relationship manager. Term advance features. Many of you have seen on a daily basis that we post a graph of the term advance yield curve, and you can access this graph as well as our entire rate histories on the advances section of the website. And this is a real good segue for a brief discussion that we're going to have on the state of the yield curve and the connection of the yield curve to term advance structures. Before that, another polling question. Curious what the audience thinks, and this is over the next year. Do you think that the yield curve will do one of four things? Will it invert? Will it steepen? Will it flatten? Or it will stay exactly the same? Brett, do you want to open up the polls to that question?
Absolutely. Polls are open and folks are voting.
Okay.
Leave it open for about another 20 to 25 seconds.
Okay, over the next year, yield curve will invert, steepen, flatten, or stay the same.
Let's give it another 10 seconds.
10 seconds it is.
All righty, polls closed. Let's share the results. It looks like the slight winner here is for the yield curve to flatten over the balance of the year. 46% of the responders expect a flattening yield curve. Coming in second place, 31% of the responders think the curve's going to steepen. 20% of the responders think the curve is going to stay approximately the same as it is today. And luckily, only 3% of the responders think the curve is actually going to invert over the next 12 months. So, John, what do we got for folks if we think the curve's going to flatten?
Well, let's look at it from a historical context. Where is the yield curve today? No signs of inversion, really. We have a spread right now today. It's about 125 basis points between 3-month bills and 10-year notes. We've had some recent scares, that's for sure. In July of 16, 10-year treasuries hit a low. You might remember that due to the Brexit worries amid a Fed funds increase that took place a little bit earlier in December of 15. We had a similar scare in mid-2012 when the 10-year was hit by the Eurozone debt crisis, and we had a spate of weak employment numbers. But in spite of mixed economic data, these days low inflation, rising employment, albeit at lower wages, it looks like the Fed has been making some signals, as they did again today, of its willingness to be a bit less accommodative. The Fed has enacted 2 rate hikes this year, with a third somewhat expected later this year. Fed watchers don't seem to think that the central bank is likely to make any sudden movements. BlackRock's chief investment strategist, Jeffrey Rosenberg, he said, I kind of like this one, that he expects the Fed to move cautiously in its unwinding process, akin to crossing a river by feeling the stones. You sort of sense that with the Fed, right? So let's look at the yield curve, a normal yield curve. It occurs when investors are confident. They tend to shy away from long-term notes, causing those yields to rise sharply. That means they expect that the economy is going to grow quickly. I'm not so sure that we see that today. Judging by stock prices, well, that we do. Investors do seem confident. Markets are somewhat anticipating, under a steepening yield curve, rising rates in the wake of the Fed's intention to sell securities. That could be. In this environment, what do? It may be appropriate to lock in rates with long-term advances and to consider capped LIBOR forward start and advances with symmetrical prepayment features. We'll talk about that in webinars 3 and 4. Let's look at a flat yield curve. That's the predominant shape over the past few years, one would argue, and it occurs when the yields are low across the board. It shows that investors expect slow growth. It could also mean that economic indicators are sending mixed messages and that some investors are expecting growth while others are not really that sure. When the curve's flat, you aren't going to save as much if you're a consumer with a 15-year mortgage. You might as well just go out and do a 30-year mortgage and invest the savings for your retirement. Better yet, some consumers might apply the savings against the principal and look toward the day that they can own the home free and clear. And as far as a bank, a flat yield curve means that a bank probably isn't going to be lending quite as much as they should. Why? Because they don't receive a lot more return for the risks of lending out money for 5, 10, or 15 years. And as a result, they have the tendency to lend to lower risk customers. They're more likely to save their excess funds in a low risk money market instrument and treasury note type of environment. Inverted yield curve, where I think we had single digits voting for that one if I recall, that's when short-term yields are higher than long-term yields. It's an unusual situation where investors demand more yield for the short-term debt than they do for long-term notes and bonds. And why would that happen? Well, logically, players would expect the economy to do worse in the next year or so and then straighten out in the long run. That's why an inverted yield curve usually forecasts, and quite accurately, a recession. In fact, the yield curve inverted before both the 2000 and the 2008 recessions. In this type of environment, appropriate strategies could have been short-term advances or term adjustable advances. I mean, even now, especially during periods of Fed and rate uncertainty, it's always useful to compare short-term advances with intermediate-term advances with short-term lockout periods. I mean, look at these term convertibles with short-term lockouts. Talk to your RMs about these. Although that spread is currently fairly negligible, just ahead of that Fed rate move in June, the spread between 3-month advances and 5-year term advances with 3-month lockouts, or periods in which we could, the FHLB, terminate the loan, was over 20 basis points. So if rates were to increase, the FHLB would likely be inclined to terminate the advance early. So there you would have a nicely priced 3-month advance. Again, talk to your relationship manager if you'd be interested in monitoring spreads between short-term advances and these term advances that are convertible with short-term lockout periods. One last item as we discuss advance features, the impact of advance size and dividend. Size discounts are typically attainable on orders between 15 and 25 million at 4 basis points off published rates, and they're above 25 million, you get an 8 basis point break. Dividends on activity stocks should logically be considered in netting out term advance rates. In this particular example on the slide, a term advance is assumed to have a 3.5% dividend that's worth approximately 12 basis points in yield. Of course, this calculation would be assumption-driven, chiefly static interest rates and dividend payments that you would assume through the life of the advance to be constant. We have worksheets at the FHLB that can help in your assumptions and calculations of netting dividends on activity stock into the advance yield. Again, just contact your relationship manager about this. So now that we've outlined the features of term advances and everything we've got in the portfolio, let's review some purposes or actual applications for these advances. We can generally categorize the purpose of term advances as falling into 3 frequently overlapping categories. 1, liquidity management, 2, interest rate risk management, and 3, capital management. All of our members manage their balance sheets with safety and profitability as their primary objectives. We spoke earlier of liquidity management as being analogous to a manufacturer employing just-in-time inventory rather than carrying the burden of underutilized assets. It's really the same thing with effectively managing your balance sheet. Like investment portfolios, term advances play a role in controlling asset-liability mismatches. On the capital side, term advance availability allows an institution to support strategically optimized levels of capital. These are levels that are not purely guided by simply the availability of deposits. We know that market conditions change, and is it necessarily desirable to automatically turn off the lending spigot simply because deposits dry up? That's a great way to lose customers. So at the heart of term advance usage is gaining an understanding of their relationship with deposits as a source of funding. It's a very tightly bound relationship that needs constant attention. There's no doubt that deposits represent franchise value and are frequently low cost, although, as we stated in our marginal cost of funds webinar of last month, it's always good to benchmark deposits in marginal cost of funds terms against other sources of funding, such as advances. We'll get to this in a minute, but instinctively, the question is, what's the best way to counter the uncertainties of liquidity and interest rate risk? We all know as bankers that it's the magic word diversification. There's one reason that deposits and term advances are so different and require complementarity on a balance sheet. Deposits, yes, even time deposits are duration uncertain, as I mentioned. Unoptioned term advances, they're duration certain. With DDAs today, as we travel through the district, we have some markets where there's a viable case made for 7-year durations, and in other markets, that same product could command an assumed duration of only 2 years. We have regular discussions with the regulatory community about this subject. Descriptors such as core or retail or volatile often call for degrees of subjective interpretation. On the other hand, if a source of funding has a defined duration, is secured, or was sourced through the FHLB, it truly is what it is. There's a lot we don't know about deposits. We do know the amount raised, but what is the duration or the actual maturity? How much is core, how much is surge? Are deposit withdrawal penalties too easy? Are we confident in repricing characteristics? Brokered CDs, some support call features, others don't. Core funding. Duration is unpredictable and overly dependent on historical regression. My mom, she's 87 years old. She's constantly on the internet. She's even watching rates. Duration may be highly variable from surge sources. You've got the pull factors, right? You've got online bill pay, direct deposits, remote capture. You've got the push factors. You have changing demographics, market channels, yields in other markets, and so forth. So even the agencies, as I mentioned, are picking up on this. According to interagency policy statements on funding and liquidity risk management, funding diversification is a frequently recommended key guidance element. Here are some snippets from various FILs from regulatory agencies. Here's one. It says, the agencies believe that a diversification of funding sources strengthens an institution's ability to withstand idiosyncratic and market-wide shocks. Quite a few of these. Furthermore, the regulatory community is on record as being concerned about the rapid sale of illiquid long-duration investments in an effort to adjust interest rate risk. And this is important, and this is why I find that earlier poll that we took regarding the preferred interest rate risk mitigation strategy as being as using advances. A lot of this is for this reason. A preferred strategy could be extension of liabilities, as we know. To quote, the FDIC strongly supports banks' efforts to control outsized exposure to interest rate volatility and will not criticize an institution for temporary adverse consequences to earnings resulting from a prudent rebalancing strategy. We're practically taught in grade school that diversification of loan types is a good way to manage risk. And we believe this concept to apply to loan types, credit quality, maturity, geography, and so forth. The same concept should and could apply to any portfolio under many different parameters. Let's examine how paying attention to liability diversification can benefit risk as well as return. The $64 question really becoming, will 100% deposit funding adequately protect the net interest income and market value of equity from changing interest rates? That's the key question that we're going to get to here through some dynamic modeling and the tools that we have available through looking at blending funding strategies between duration certain advances and duration uncertain deposits. We'll spend the balance of the webinar further developing this idea, effectively, again, combining deposits and advances. But before we do this, I wanted to make a quick note on another term advance strategy that many institutions might want to consider, and that's restructuring of their existing advance portfolio. Now, depending upon accounting treatment, members may be able to extend the maturity and reduce the rate of their existing advances. For some advances, including those with options, it's frequently possible to blend the contractual prepayment fee, if you were to pay down an advance early, right, into the rate on a new term advance. There's no cash settlement of the prepayment fee since it would be blended into the rate of the new advance. This transaction would allow members to extend the maturity of their existing advances at a potentially lower rate on the new advances compared with the rate on the original advances, and again, without taking on additional cash or purchasing additional stock. As an example, liability-sensitive members, and it looked like we had a few on the earlier poll, or those wishing to pick up some additional asset sensitivity, this strategy of extending advance duration without increasing balances could be worth considering, not to mention the possibility of improving interest margin. We won't play the role of accountant here, but they will need to weigh in on transactions of this type in order to determine if the advance restructuring could be accounted for as a debt modification or an extinguishment of debt. If it's an extinguishment, generally you need to book the rate differential as a one-time prepayment fee or loss. And it would also entail classifying a new advance on the books as its new coupon. On the other hand, a modification would entail accounting for the embedded prepayment fee over the term of the new advance. And the expense on the new advance would simply consist of the new coupon plus the accretion of the prepayment fee. And all of this is governed by something called 470-50, modifications and extinguishments. And again, talk to your accountant about this, and importantly, talk to your relationship manager if this is an idea that you'd like to pursue. Just a quick example of what I'm talking about here. Here's a portfolio of 5 original advances. The member would like to extend liability duration without increasing the overall size of its balance sheet, and they'd also like to see if they could lower the cost of their advance funding. And if you look at the life and before and after, it looks like in this example the blended interest rate moves from 371 to 295, and the portfolio years to maturity, they increase. You're extending your liability duration here from 1.78 to 5.32 years. And funding, guess what happens there? That remains entirely the same at $77.5 million. And you've got this new blended advance rate of 2.95%. That would be slightly higher than the weighted average rate for standard posted advances currently, again due to the fact that any prepayment assessments would have been absorbed into the amortization of the advance to term, right? You're not prepaying an advance, but that prepayment penalty is essentially embedded into the coupon. So with that, I'd like to propose another poll. Brett, if you're ready, I'd like to propose a question to the audience. And it goes like this. Has your institution ever considered the potential merits of blend, extend, let's call it, blend, extend funding restructuring? And the possible answers would be yes, or no, or not sure. Brett, you ready for this?
We're ready. It looks like Just over 55% of the respondents have voted. We'll give it another about 10 to 15 seconds.
Okay, blend extend funding, have you considered it? Yes, no, not sure.
All righty, John, let's give it another, call 5, 6 seconds here.
Okay.
All right, it looks like just over 50% of you, 52%, have not considered a blend and extend strategy. 30% of you have, and 17% aren't sure. John, as you know, we saw a lot of this activity just after the credit crunch in 2009 and 2010, and then a pickup again in 2013 as rates dipped. On the balance for 2017 and beyond, this is still a very viable strategy, wouldn't you think, John?
I think so. You know, more and more we're seeing duration drift. We're seeing durations that are coming in. You know, originally people had taken out advances of the 5-year variety. 3.5 years have lapsed, and we're getting increasing requests to the RMs saying, "Hey, can you look at the advanced portfolio? Let's work some numbers up." If the numbers do look attractive, it's time to engage the internal and external accountants. But it's a very interesting strategy to pursue. Okay.
And John, we have a tool that we can share with folks, or at least share the results, correct?
Yes, we do. Talk to your RMs about that, and we will share that with you. Okay, Brett, thanks very much. We'll now look at putting the theory of liability diversification into practice. And we can do that with the FHLB Des Moines and our group, as I'll point out. But the strategy of blending laddered term funding with deposits, we're going to focus on several key objectives here, including establishing and protecting spreads, coordinating funding flows with asset cash flows, and complementing your deposit base with wholesale funding. So at the end of the day, examining various blended funding scenarios is going to help you make loans that your customers want and create funding solutions that meet your risk and return parameters. Or, for that matter, you can match fund a single loan or a portfolio of loans. We see many members regularly review blended funding output with their loan, credit, and ALCO committees, and we can help you with some of that output. Simple. The blended funding concept involves using term advances that can either be bullet or amortizing structures and supplementing them with low-cost, admittedly duration uncertain deposits. You want both. Why duration uncertainty on deposits? We know that deposit lives can change because of rate environment, geography, type, access, and so forth. The idea here is to create some partially matched funded flows with advances in order to build in some prepayment protection against asset prepayments. Deposits would then act as supplements due to their low cost and because of their value in the event funded assets are on the books for longer than expected. So there are a few steps you're going to take that are involved in developing a blended funding strategy. First, you're going to need to understand your deposit base. Why? It's the largest funding component of your balance sheet. You're going to need some idea of how sensitive your non-maturity deposits in particular are to changes in rates. Next, you're going to need to consider the character of your asset cash flows. Remember, you're in the business of funding cash flows and not maturities. A 15-year loan is not a 15-year asset. We know that the average life of a 15-year mortgage can be roughly 5 years. First, you're going to look at fixed-rate funding to provide structural support with bullet or amortizing fixed-rate loans. Next, you're going to complement the fixed-rate funding with non-maturity deposits to plug the funding gap. And finally, you're going to compare the relative impact of each strategy with and without a blended funding approach. You're going to measure it on the basis of net income as well as EVE. As an example, our member strategies team, in conjunction with your RM, we have the ability to work with you and develop customized funding scenarios for customized balance sheet growth strategies. We can either model out blended funding strategies for either single loans or a portfolio of loans. The way we test it is dynamically. We dynamically blend funding strategies that can represent a blend between staying short, getting as much current income as you possibly can, and extending the majority of your funding or maturity of your funding immediately in the event that rates rise. We'll now look at a specific case of setting a blended ladder term funding strategy. Here's a case of a bank whose borrower wanted to fund a $5 million 10-year commercial real estate requirement. The asset could have unique parameters, say a gross coupon of 4.5%, a 10-year nominal maturity, and a 12-year amortization. Here the member decided to fund via two $1.15 million laddered loans, advances, one a 5-year bullet at 214 and the other a 6-year bullet at 232. And here you can see the remaining funding requirement was covered by, at least initially, a $1.7 million in deposits with an assigned weighted average cost. Further assumed that after the maturity of the laddered advances, deposits would then take on the role of supporting these remaining tail advances, as you can see past year 6. The result, an optimal blend, would be completed with the assistance of some dynamic modeling tools. Why would you not fund the tail risk? Well, we're talking about the least dollar amount outstanding and the most expensive to hedge. It should at that point present the lowest amount of risk. In the static case of dialing in, as another example, some 15-year mortgages, this member chose to use term advances to build margin and mitigate interest rate risk. So as we review the benefits of dynamic modeling, one of the key items we're going to need to focus on will be the role of deposit composition as a funding source. And as I mentioned, different deposit types are going to have different responses to rate changes. For example, transaction accounts are generally associated with low betas, and MMDA accounts could support higher betas. Remember what a beta is. A beta represents a measure of the relationship between the deposit category's reaction to a general rate change. On a national scale, due to a decline in the funds rate, there's been a slight uptick in MMDA savings and transaction account betas at the expense of time deposits. Why does the shift imply duration uncertainty? Is duration determined by terms or behavior? I mean, it depends on your market and your institution. But non-maturity deposit assumptions are absolutely critical. Same thing with the credit unions. There's been a slight proportional decrease in share certificates, more in the way of less duration certain liabilities. And over the past 7 years, borrowings have remained the highest yielding category, although spreads with interest-bearing deposits have been narrowing. Individual components of the funding base needs to be tracked and benchmarked. And don't forget the lesson learned in last month's webinar. Depending on cannibalization rates from existing depositors, marginal cost of a borrowing could well be less than that of a depositor. Just last week, we were evaluating with a member the possible implementation of a commercial deposit product, matched against some likely cannibalization assumptions against existing deposits. A nominal assumed rate of a 50 basis point proposed commercial deposit product exceeded 5% on a marginal cost basis. So the numbers can get very tricky here. Okay, so what are the current betas in the marketplace? Of course, it depends, as I mentioned, on your unique circumstances. At this winter's KBW conference, there was a lot of talk of national banks seeing weighted average betas of 40 to 50%. With the regionals expecting something in the range of 30%. We've seen smaller banks estimating MMDA and savings betas over 60% these days. In our district, we hear anecdotal estimates of checking, as I mentioned, between 2 and 7 years. It's quite the range. So if you, let's see, I've got the ability to scroll down here. Here we are. There we go. A little bit of latency. If you analyze the historical balance and rate data, it can help you distinguish your deposit categories' degrees of rate sensitivity. Generally, a deposit category's rate sensitivity is inversely correlated with the length of the relationship with the member, the number of other products used by the member, and historically infrequent rollovers in a rising rate environment. Here's an example. Here's a 5-year history taken at the national bank level of balances. You can see the balances in bars and rates on various share categories or deposit categories, as the case may be, and a market index, in this case the 2-year Treasury. Each and every institution, all listeners, should really be in the business of collecting this sort of information on a regular basis throughout multiple economic and liquidity cycles. Correlation statistics, they're a helpful guide to guide deposit categories' degrees of rate sensitivity, not to mention deposit studies. Once we model a blended funding strategy, we can get to a 30,000-foot discussion as represented on this slide. Here we'd have a portfolio of loans that are being funded by a mix of laddered, amortizing advances, and 33% funded via a portfolio, at least initially, of deposit funding. Here in this simple example, we're going to be looking at blended laddered term funding consisting of, again, deposits and advances. Let's look at the behavior of deposits. As we develop this blended funding model, that again is dynamic and includes assessments of rate sensitivity under varying conditions, here's the approach we take. We break down and allocate each deposit category that we're going to use in the overall funding. We're then going to overlay their respective betas against possible rate incomes. Here a down to 300 and up to 300. And we're also going to look at the asset side and make some assumptions about their prepayment speeds under different rate scenarios. Finally, we're going to agree on a blend of deposit and borrowings. In this case, we're evaluating a strategy of funding a $5 million asset, assumed to be a 30-year mortgage or mortgages. One half of the funding is going to be sourced from the deposit portfolio. The other half is going to be derived from a ladder of 1 all the way out to 7-year advances. And we've assigned allocations and pricing betas for each of our deposit categories. And with these inputs, we can derive each deposit category's cost in a variety of rate scenarios. So in this case, the average life of the asset we're going to be funding in a base case scenario is 4.5 years. We've assigned different CPRs for different rate scenarios as an example. Our weighted average cost of core deposits is going to be assumed at 40 basis points, and 65% of these deposits are non-maturing. So we're going to assume an average beta in the deposit portfolio of 57 basis points. Then finally, I'm going to summarize additional inputs. We're dynamically going to model the $5 million asset by being funded with $2.5 million again in deposits, with a weighted average cost of 40 basis points, and $2.5 million with advances with a weighted average funding cost of 207. And then once we've modeled a blended funding strategy against those varying assumptions and rate scenarios, we get a better picture of how funding diversification can play a positive role in a rising rate environment. In examining net income scenarios, take a look at the graph here. The crossover point seems to be in favor of the blended funding scenario with a rate move of about, it looks like 150, 175 basis points. That is, that if rates go beyond that point, you're generally better off with a funding blend. Let's look at life in terms of market value of equity. The crossover point in favor of the blended funding strategy when you're looking at market value of equity seems to occur right at the unchanged rate scenario. A 100% deposit scenario shows an underperforming result in a higher rate environment. Well, you know why? Deposits, they bear uncertain durations again. If rates were to rise, the increased sensitivity of higher beta deposit categories would kick in, and what would happen? Your margin, your market value of equity could contract. The certain duration, on the other hand, of term advances would be preserved, while the formerly low-cost deposits particularly those with higher betas, would increasingly add to the cost of funds. Just about it. Picture time. This is a remote lake in Patagonia, Argentina. It's the home of wild weather and clouds. They're called lenticular clouds. A lenticular cloud is a lens-shaped cloud that normally develops on a downwind side of a mountain or a mountain range, and it occurs when stable and moist airflows over a mountain occur, creating a series of strange-looking UFO oscillating waves. Lenticular is a Latin word that means lens-like, another reference to their shape. Bottom line, what does this have to do with the shapes of clouds? Well, our funding strategies team has the capacity to help you apply a close lens and help you examine asset and funding strategies that are right for your balance sheet and are right for your customers. The FHLB Des Moines is in the business of helping members generate blended funding scenario analysis. Deposit funding could involve the use of longer-term fixed-rate advances, amortizing advances, or a combination of the two. And we can help you graphically visualize the cash flow characteristics of loaned advance structures on a dynamic basis. We're your cooperative. Engage us. And I'm going to give you some details on the next webinars we're going to have. We are going to, on September 12, going to be dealing with forward starting advances, 1 to 2 Central Time. You're going to learn how to lock in funding for future anticipated needs. Then we have another webinar, Symmetrical Advances. Put that on your calendar, October 10, 1 o'clock Central Time. We have some time, little bit of time for some questions. If you do have any questions, feed them into the right-hand side of your screen. We'll take them. Brett will monitor them, address them. And I see there are a few that are coming in. Brett, why don't I start out here? Would that work?
That works, John. Fire away.
Okay, so we have an audience member saying, you mentioned the term LIBOR advance. The Fed's Alternative Reference Rate Committee has recommended discontinuation of LIBOR in the future. Is there a future reference rate, and how will this impact your LIBOR-based advances? Interesting. Well, I mean, we do know that the Fed has indeed selected an alternative rate for LIBOR contracts of all types. It would apply to swaps, loans, advances in members' portfolios, right? I mean, what have you. And we do know that there's some talk by the Fed that the surrogate or the replacement would be something like a Treasury repo financing rate. We don't know much more beyond the fact that it's likely to be a very long transition period. We don't know how long, but we do know, and I think I saw the number, it was something to the tune of $350 to $400 trillion in LIBOR contracts that are out there. So you might even dismiss the possibility of a transaction or a transition occurring at all. Any other questions here? One more, a couple more. Somebody asking about the community investment advance limit. They're asking, would the advance limit of $10 million apply to outstandings at any one time, or is it per year? Well, the answer to that is that the $10 million would be the amount institutionally that can be outstanding at any one time. We did increase the level from $6 million, which was operative last year, and these levels are revisited annually by management and receive input from our Affordable Housing Advisory Council. Hope that answers the question. Another question. Okay, so you're talking about coming up with an optimal mix of laddering funding. So I assume they're talking about how do we get the right mixture, the right blend between deposits and advances. We can certainly help you with that. What we do within the strategies division of the FHLB is we use ZM software, and the software can help us look and evaluate asset prepayment behavior, these deposit betas that I talked about, and other inputs. And then collectively they go into a random analysis which can help identify optimal funding mixes. Sometimes these mixes on the computer suggest a lot of different advanced maturities, which we often trim down just for the sake of simplicity. Brett, any other questions that you're seeing?
John, I don't see any other questions coming in.
Okay, well that's timely then, because I have exactly the top of the hour here. Thanks very much for joining us, and again, those who are on the line and who have registered for the webinar, you will be getting access to the recording and the slides. Thank you so much for joining, and thank you so much for the support of your cooperative. Take care.